Well, it's time for another Rogers Capital monthly market commentary where we attempt to be the antidote to water cooler wisdom. September is here, fall is here, cooler temperatures are here, maybe even some rain, hallelujah. So August was a tough one. The markets had a little bit of a pullback, about negative 1.6%. That puts us at a year to date, 8 months through the year, 17% gain. So still a great year, a little bit of a pullback last month. Big news of the month in an unanticipated announcement, Fitch, which is one of the big ratings services, lowered their rating on U.S. debt from AAA down to AA+. And they cited two reasons: the increased potential for economic recession, and secondly, a rising and increased interest cost or burden. That's the first time we've had a decrease on that U.S. credit rating since 2011. The impact of higher interest rates, that interest rate burden, stubborn inflation, appears to be impacting the American consumer as well. Data from the New York Fed revealed this past month that total credit card debt rose to a record $1.03 trillion in the second quarter. The average card balance is over $5,900. And that's the highest level in 10 years. Now, delinquencies and default rates are probably a more accurate measure of consumer health. The rate of new credit card and new auto loan delinquencies stands at 7.2%, which is rising above and past pre-pandemic levels. Now, higher interest rates aren't all bad. Did someone say bonds, fixed income? Yeah, what are those, right? We haven't seen much of those. After 4 years of negative real yields, in other words, what they're paying less what inflation is taking off of that yield. So after 4 years of negative real yields, bonds are finally providing a rate that outpaces inflation. We're actually beginning to see some decent bond rates on new bonds, new bond issues. And of course, many of us have talked through a money market option that's paying better than 5%. So it has been forever, right, since that has been the case. So not all bad, higher rates. Now, on the equity side, the S&P, the stock market, closed August at over 5,500. That's just 6% below the all-time high, which was in January of last year, 2022. 10 out of the 11 sectors of the market, or the index, registered negative total returns for August. The best performer, not only positive, was energy, so oil and gas. The worst was utilities, which is kind of interesting because utilities is the most defensive sector of the market. As indicated by July's CPI, or inflation number, of 3.2%, the Fed has made significant progress in the battle with rising prices. Now remember, a year ago that number was 8.3%. So 8.3 down to 3.2, we've made quite a bit of progress. That said, inflation remains well above the Fed's stated goal of 2%. And it's beginning to now look like it's taking a toll on the American consumer, the American household, you and me. While the consumer's been amazingly resilient throughout all this, we've talked about this multiple times in previous months. The San Francisco Fed reported that as of June, U.S. households have significantly less excess savings than they did during the pandemic, which makes sense. Rising prices and using some of that savings, finding it tough to keep up. In fact, estimates suggest that those reserves may be depleted sometime this quarter, which could lead to a slowdown in consumer spending, which of course is not good news for the economy as a whole. Recent survey revealed that 61% of U.S. adults are living paycheck to paycheck. And that's not just here. As the world battles rising prices, growth is slowing. The latest global growth numbers forecast from the IMF suggest 3% GDP growth for this year, which is down from 6.3 2 years ago and 3.5 last year. So the story sounds similar to you. I wish it were different, but inflation, the Fed's response to inflation, and of course, as we've talked in recent months, the likelihood of recession in the third or fourth quarter and how severe that recession will be. Well, that's it for this time. Enjoy the cooler weather and football season, and we'll talk to you next time.